in just 60 days. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today is a countdown to chaos as a banking elite's sinister plan to crash the global economy is exposed. And they made this move today. They put out the warning signal that starting in 60 days, they're going to initiate their master plan. And what we saw from Wall Street and the other major banks is, well, the alarm bells were sounded and moves have already been made. And if you're wondering why these banking elites want to bring down the global economy, well, it's really simple. If you go back to the global financial crisis, what you find out is there was unlimited spending, unlimited deficits, and unlimited bailouts, all because, well, rates were at zero and the system was about to fail. And speaking of failures, there's signs that the U.S. economy, which everybody believes is immune to the next downturn, is finally seeing some cracks. Well, new evidence to suggest we indeed are. And many people wonder why various parts of my face are a brighter color red than others. Well, it was due to the fact I was born with a genetic condition. If you'd like to know more about what I'm going through with what I have and my treatments, head over to my personal Facebook page. I'm going to post a big update here real soon, and you can find out what's going on with me. Now let's go to Bloomberg, where we picked today's story up with a headline is the ECB holds interest rates and points to the first cut in June. And my friends, this is coming in 60 days. And at the headline story, most people think, well, this is innocuous, and yet it has devastating financial consequences that kicks off what is the beginning of the next global financial crisis. And again, you think about how this is a deliberate move. You look at governments around the world, they're running massive deficits. They just cannot get their spending under control. And what do they need? Well, they need rates to come down in a big way, and they want to continue to spend. Well, the easiest way to do that was to drive the global economy into recession. As far as the banks, well, we already know they'll get a bailout. They did before, they will again. And if the Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission were to further increase its confidence that inflation is converging to the target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. And that's kind of the whole basis of their moves, to say, well, inflation's coming down, and so we need to cut rates. Even though we know there is no direct link to rates and inflation, is actually what the ECB and other central bankers do is up to them. There is actually no guidebook. So the issue here is they're saying we need to cut rates, which sounds good because the story is we've been restrictive and now we need to ease off as we get to our targets. But it's much bigger than that. And while it said it would remain data dependent and it isn't pre-committing to a particular rate path, this is a signal of a prospect to move within 2 months' time. And that's exactly what central bankers do. They come out and they give the market signals of what their next move is likely to be and when it is, so Wall Street and the other banks can begin preparing for it. But what nobody realizes except these central elites is how they're going to trigger the next crisis, which I'm going to show you here today. As money markets held bets on monetary easing in 2024 roughly steady with 3/4 point rate cuts priced in, and here you see the beginning effects. The euro fell to its lowest level since February, and that is something that's really important to understand, is because we're starting to get a divergence in currencies. Now, even though we can show that currency values have nothing to do with central bank policy, the initial effect of it is the market believes that. And as long as the market believes something, well, we see those moves. And if we look at the dollar here shown in red against the federal funds rate, we can see the Fed cutting, but you'll notice the dollar does go down. In fact, it was already in a downtrend to begin with, but notably the Fed continues to cut as the dollar rallies, suggesting that the Fed really doesn't have control over the dollar like many think it does. In fact, looking at about 2015, we see the dollar begin to rally. The Fed doesn't raise rates starting until 2016. And somewhere near 2018, the dollar gives up steam and the Fed keeps going. In fact, heading into the pandemic, the Fed was cutting. The dollar went, well, sideways. And it wasn't until 2022 when the Fed said, we're going to go on the most aggressive hiking cycle in history, we look back, the dollar was leading that. In fact, the Fed continued to cut as the dollar gave up steam. So we're seeing here some initial reactions, and this currency issue that's going to cause a dislocation is going to disrupt the global economy. Now, on the early side of this, many people are going to say this is a good move because a weaker euro means demand for their factories is going to be revived as people look for lower cost areas to manufacture that will pull business from the US and other places and thus lead to a revival of their economy. That is, unless global demand is actually far worse than anyone wants to acknowledge. And that's just beginning steps because there are a few such concerns for the ECB. We saw inflation fall a touch short of estimates last month at 2.4%. And while underlying pressures remain elevated and services costs are still rising by 4%, figures this coming week may confirm a moderation in wage gains that are driving such stickiness. And that's important because we've been talking about how wage gains are coming down in a big way. But one thing that continues to rally, at least here in the US, is the energy sector. Many asking, how could I have participated in that? Well, our subscribers had a huge advantage, and you can too. Want to be an expert at trading energy, or well, any sector for that matter? Well, check this out. Back on January 25th, we have two reports. One that looks at machine positioning. We showed you this extreme short position. Our signals flipped, giving you the lead to buy in before the machines. Had you done that and put a simple $5,000 trade in, you'd be up $936 or 18.72%. Your cost for the first year of the whole report would be $330. Talk about paying for your whole subscription in one trade for years to come. But maybe you like to trade the technicals. Problem is you find yourself getting in late, out early, not knowing the right moves to make. Well, we have a second report called Momentum Timer Pro, which smooths out all those signals and adds one proprietary overlay that keeps you in the trade early and longer. And here you see on the following day, that kicked on XLE as well. If you would have taken that trade, you'd be up $853 or $17 or 17.606%. And the total cost of that, $220. So it doesn't matter if you're a trader or maybe you're looking to enhance the returns of your 401k by taking some big moves. We give you the tools. There's a link in the description for both reports. 30-day free trial. My friends give you 7. Why do I give you 30? Because we'll show you how to make money trading. We give you the reports, a video. In fact, I put out a big video on Wednesday to all our subscribers going through a bunch of our old recent trades. You can take advantage because one thing we're going to see here is some big moves. Now, we're talking about wage growth because here you can see that separate poll showed companies expect wage growth to abate over the next 12 months, with economists at Goldman Sachs predicting a significant slowdown in the second half this year. Now, many of you know that I have been making that same comment, that wage growth is indeed slowing. But how do we know that? Well, it's very obvious. This is one case. The data is very dependent, not like the Fed, but we can look at the consumer price index here shown in blue against average hourly earnings. We're going to look at production and non-supervisory employees, this shown in red, both on a year-over-year rate of change. And what's important is there are periods where employers do give out raises when they're not raising their prices as aggressively, and they get squeezed at the margin when they do this. But overall, what employers like to do is raise prices, get more revenue, and then pass some of those gains on to their employees. So we can note that periods where consumer prices are decelerating, well, it's either usually led by a deceleration in wages or it's followed by one in the near term. And you can see these dislocations were a little bit broader in the 70s, but as we move into the 80s, what happens? We see consumer prices come down and wage gains slow down. And it makes perfect sense because if employers can't raise their price, they can't give out wage gains. There is a limit to how far they can go. And so what we're seeing is even though the consumer price index appears for the moment to be rather sticky at its current level, well, what it's telling us is there's going to be a further deceleration in average hourly earnings, meaning workers aren't going to get as big of raises as they're hoping. Of course, without those, that means their spending power continues to get eroded by inflation. Less spending power against higher interest rates means, of course, the ultimate less demand for the economy. But we're coming back to this move now of what the ECB is doing, why they're signaling to all these banks around the world that they are indeed going to kick off the next crisis starting in 60 days by what seems to be an innocuous move. One simple rate cut, well, we already know the euro is headed down, and here we can see that monetary policy should exert less of a drag on demand over time, although it's stressed that risks to the euro area growth remain tilted to the downside, and a weaker currency would indeed help this. But there's only one problem with that, and a big one, and it's everything to do with the dollar. We'll get to that in a moment, as inflation is expected to fluctuate around the current levels in the coming months and then to decline to our target next year. We're not going to wait until everything goes back to 2% to make that decision, because it'll be necessary in order to make sure that inflation returns to 2% sustainably at target in a timely manner. So what we continue to hear from these banking elites is, hey, you know what? We went into an overly restricted policy. We need to pull back the reins a little bit, and then it will settle within our targets. But again, we come back to this issue with the currency, and we see again, euro extends decline after the ECB holds rates at high. So again, the ECB hasn't made a move, and what do we see the banks and Wall Street do? Well, they're already starting to dump the euro, and this is key, because if you think about this from an economic standpoint, if a currency is weakening, we can look around the world and say, well, that means the yuan and yen have also been weakening. What does that mean for the almighty dollar? Well, it gets stronger. And what happens in that case is people holding euros, yen, or yuan, they want out. And what do they want to do is put their money in the dollar, which is getting harder and harder to get. It's getting more costly to get, driving it up even further, making the U.S. less competitive from a manufacturing state across the global economy. This leads to putting the brakes on our economy, but also drives the dollar and demand for the dollar a whole lot higher. And some Eurozone policymakers, as in the UK, may want to avoid cutting rates much more aggressively than their counterparts, partly out of fear of weakening their currencies and doing so further stoking inflation. But that's just the whole point here. If you see an exodus out of, say, the euro, the yen, and yuan, and all flooding into the dollar to protect the value of their money, well, what does that mean? Is you're going to see further downward pressures on those currencies, and then all of a sudden, inflation starts to rear its ugly head. The question then becomes, is can consumers in their respective countries afford those higher prices? If they can't, then that inflation is going to be transitory. But the issue here is you get a much stronger dollar out of this, and you start to see these dislocations cause issues inside the global economy. And that means, of course, bond traders are now thinking this leads to a 5% yield in a no rate cut world, that the Fed finally nailed the impossible here, that means there's no chance the Fed could cut rates unless this move is to get the Fed to cut rates, because we know they want to as well. We know the current administration is running massive deficits. It's likely that's going to continue no matter what happens in the elections, at least in the beginning phases of it, because we need to get this under control. The problem is we have a lot of debt that's being issued at high rates. We have a lot of debt that's being matured and reissued at high rates. And what do governments desperately need is rates sitting at zero, maybe ideally even negative. So how do you get the Fed to cut rates when they can't, because they box themselves into a corner, and now they've got the market saying, look, U.S. rates are going to go up. But think about the dislocation here. If the ECB is cutting rates and their currency is losing value, people want to get their money out. And where will they want to go? Well, they're going to go to the dollar, but they're also going to look to U.S. Treasuries in a big way. And I want you to be thinking about this. Let's say that you were going to buy a CD and your bank had a certain rate, and you looked in the paper and maybe you see one of the competitive banks in your town had a higher rate. Are you going to leave your money where it's at, or are you going to move it? In this case, it's obvious the rates here in the U.S., while traders think they're going higher, what you're going to see is money flooding into the U.S., into the dollar and dollar-denominated assets in a big way. And that's not good for the global economy, because what you need is money flowing through it, out of the U.S. into the global economy, not back into it. This puts pressure on the Fed in a huge way. And I don't think 5% or higher is out of the question for 10-year yields. I'll make the the case, it may be that could happen in the very, very short term, but highly unlikely. The fund is also positioned for the chance the Fed doesn't cut it all this year, which we made the case they will, because the asset manager holds bearish positions on the 2, 5, and 10-year bonds. But keep in mind, if we continue to see the dollar go up, which is what's driving yields up in the short term, what that means is the U.S. economy gets less competitive against the rest of the world, and that means business and new orders gets transferred to other parts of the world, leading to further unemployment here. But let's talk about the dollar in yields, because a lot of people think, well, if the dollar's going up, yields have to go up, and that is not the case at all. We can see here during the global financial crisis, the dollar screamed higher and, well, rates came down. You can see here around 2010, the dollar started going up, yields went down. You can see around 2011, 2012, 2014 into 15, 2016, 2019, going into 20, and you can see this relationship. Right now they're linked, but it doesn't mean it has to stay that way, because you start to understand, again, if currencies around the world are losing value against the dollar, people are going to bring their money here, and then they're going to look to earn a higher yield than they're seeing in their own country. That means they're going to buy into U.S. debt. And you start to see the mechanisms in the next financial crisis start to happen, because if yields in the U.S. start to fall, what does that mean? Well, it means the curve is starting to steepen, and that means inflation, of course, comes down. But that also starts to mean that if rates here go up, a lot of people think that means good news for the economy. It doesn't if people can't afford higher rates. If we continue to see delinquencies go up, and that causes spending to drop, which we'll already notice happening because consumers are balking, saying, look, I want to buy things, but I can't afford them at the current rates. And we can see throughout history that higher rates can lead to a decline in inflation. You see it back here in 1970. You can see it in 75. You can see it going into the 80s, where yields are skyrocketing, inflation comes down, and then rates all of a sudden decide to reverse. You can see it here in the early 90s, see it in 85, 95, 2000. You can just go on and on. There are plenty of times when higher rates actually lead to less spending, and that's the position we're in here now. But again, we talk about the yield curve here, because if money starts flooding into the U.S. financial system and starts driving rates back down, that means the yield curve ends up steepening. And when the curve steepens, well, that means the Fed's cutting, because here we can know, we look at the 10-year, 2-year, so if money floods in here because not only is the dollar more stable than their existing currency and going up in value, but rates are higher, giving people an added return. Well, what that means is the red line starts to steepen. That's your yield curve coming out of an inversion. And we can note that each and every time the Fed cuts rate. And so what's happening here is the ECB is going to force the Fed's hands, get the Fed to do what they want to do but cannot publicly do, get them to cut rates. Because if you really want to know what the federal funds rate is correlated to, it's not inflation, it's not the labor market, it's nothing the Fed says. It's 2-year Treasury yields. You get a bunch of money flooding into the 2-year, and you see 2-year yields shown in red start to come down. Next thing you know, the Fed is going to aggressively cut in a major way. But they may already be headed toward that position now, as we got the producer price index, which says the U.S. economy is not as great as everyone thinks, and the consumers are indeed struggling to pay these higher prices. Here you can see U.S. producer prices rise, but show some relief in key categories. When you forget about that, the real issue here is that final demand rose 2.1%. That got the market excited. But on a monthly basis, look at this. Producer prices increased at less than forecasted 0.2% after a sharp advance in February. And why would producer prices not advance as much? Well, maybe hours worked are going down. Maybe wage growth is slowing down. Maybe even demand is falling and inventories are starting to build. And sure enough, we can look at cases where producer prices are rising. Here you can see in red showing in final demand against the consumer price index. And what does that mean? Well, it doesn't mean consumer prices keep going up, because if consumers can't afford them, well, it means indeed prices are too high, and that means demand's coming down. We see that effect here. So you can note that producer prices are rising faster than consumer prices. telling us indeed things are changing here in the U.S. The PPI data showed a third straight increase in the cost of services, which is proving to be the main reason why inflation has been stubborn, prompting traders to dial back their expectations on how soon the Fed will cut rates. But look at this, the PPI, excluding food and energy, it all rose at 0.2%. That isn't a big number. We're seeing a slowdown in the U.S. economy, but the ECB is trying to get this kick-started, get the Fed to cut rates. How do you do that? You cause an all-out crisis, drive money into the U.S. financial system, drive those rates down, get the Fed to cut, tighten financial conditions. And here you can see, while central bankers are awaiting a downshift in services inflation as they debate when to lower rates, the recent trend in goods deflation is at risk of stalling due to rising prices of oil and some other commodities, as crude oil prices are hovering near the highest since October on geopolitical and supply concerns, threatening to raise production and transportation costs that could filter through to its consumers. Well, here we can see there are times that crude oil prices, which do tend to lead producer prices, you can see that very clearly, but there are times when crude oil prices get too high, consumers can't afford them either. It drives producer prices up as well. Consumers can't afford that, and all of a sudden it leads to a decline in spending and then sets off the next cycle of the U.S. heading to recession. At the same time, these banking elites are set to trigger an all-out financial crisis, driving the global economy into recession so they can cut rates back to zero. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.